Hi, I'm Roger Montgomery from Montgomery Investment Management, and welcome to this week's Video Insight, and a Happy New Year to you. Well, recently market volatility has been attributed to various things. Some have focused on the Trump-Z battle on tariffs, and others have blamed the pain in Britain. But my experience tells me this is just noise. These things are just a distraction for long-term investors, and they will pass. 24 months ago, nobody was predicting the US-China trade war, so you can be pretty certain very few, if any, will correctly predict the outcome. Of course, professional investors can look very wise discussing the outcomes of present scenarios they completely failed to predict. Investing, however, can be very successful without the ability to predict the next shadow to jump at. So let's look at some facts. This chart shows the US stock market is historically overvalued. Robert Shiller's CAPE ratio sits at just under 30 times. Go all the way back to 1870 and you find only two periods where the ratio was at the same level or higher. And Warren Buffett said it was an absence of value that blocked virtually all deals he examined last year, which explains why Berkshire Hathaway's cash pile has grown so much. This Bloomberg chart shows cash at Warren Buffett's Berkshire is at a record high and is now approaching $130 billion. That cash balance represents about 27% of Berkshire's market capitalisation, but because Berkshire trades at a premium to its book value, the cash balance is about 34% of Berkshire's book value. It's Warren Buffett's single biggest portfolio position, and there's probably good reason for it. It's reasonable to conclude the major market index remains expensive, although for smaller investors than Warren Buffett, there'll always be individual companies that represent good value, no matter where the index is. The question, of course, is what will happen next. If every investment banking analyst and market strategist is distracted by trade wars and Brexit convulsions, what might the catalyst be to provide investors with an opportunity this year? My take is the catalyst might come from the credit markets. Now, we've been talking about this for some time. Back in April 2016, in an interview for Peter Switzer, I warned investors about rising default levels in the US, saying, I'm very concerned that we're going to see some sort of credit event. And between now and 2020, we're going to see in the US alone something like $947 billion refinanced, and that's junk bond debt. In 2020 alone, that amount is $400 billion, and it's the most ever. Then again, in October 2017, more than a year ago, I wrote an article for Professional Planner magazine where I said, the Bank of International Settlements is concerned by the rise of covenant-like junk bonds, which now account for 75% of all leveraged bond issues. Moody's says covenant quality is at its lowest level since it started measuring this in 2011. Value investors like us tend to be early in their warnings, and often the party ramps up after we've left. But 2019 and 2020 are now on our doorstep, and Treasury bond rates make Treasury bonds much more attractive than corporate bonds. Importantly, the lowest investment grade, the BBB rated bonds, have grown to 47% of all corporate bonds. Now that's a record, and the massive increase in the net debt to EBITDA ratio to levels much higher than those seen at the peaks of the previous two cycles, and with more than half of BBB companies in the US and Europe looking more like high yield than high grade, it suggests this year could see a wave of downgrades. Investors should be concerned that if these downgrades transpire, there's a wave of selling by fund managers that are only allowed to hold investment-grade bonds. And of course, there's the record level of CCC rated bonds due to be refinanced that we've been alerting investors to since April 2016. Since September last year, the Bank of America Merrill Lynch US High Yield CCC or below effective yield has risen from 9.57% to 12.37%, as this chart shows. With Treasury bond rates having risen from 1.36% in mid-16 to over 3.2% more recently, the appetite for refinancing lower-rated corporate bonds has probably diminished, and the rates at which they'll be refinanced, if they are, will be higher. So it's not a stretch to expect more volatility this year. And with perceived risk higher, investors simply won't be willing to pay such high multiples for $1 of earnings. So my guess is 2019 presents some terrific opportunities to buy high quality businesses at cheaper prices. If you're an investor, cheaper prices probably mean a willingness to invest more rather than less. Obviously, you need to take advantage of short periods where opportunities are abundant to get set for the next decade. And I think this year, and potentially next, could represent those opportunities. I look forward to talking to you again throughout the year, and in the meantime, be sure to follow us on Facebook and Twitter.